Hey everyone, we got some huge news for SoFi stock investors in the form of the company's quarterly earnings call. There was a lot said in this call that I think SoFi stock investors cannot miss. So you're going to want to tune in to see the big picture highlights from this quarter's earnings call and what it could mean for SoFi stock investors. So
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's jump right in, starting with CEO Anthony Noto saying that the financial services segment achieved positive contribution profit for the first time, making all three reported segments profitable while bolstering our consolidated profitability, even while we continue to invest aggressively for high levels of compounding for years to come. And that is good news for SoFi stock investors, especially considering that management has said in the next quarter they expect to be profitable on the bottom line. It certainly helps when all of your segments are contributing to profitability. That way, regardless of where the growth comes from, it boosts your profitability versus if only two out of your three segments were profitable, that would make it so that if your growth came from the one segment that's not profitable, it could hurt profitability for the company overall. So this is good news for SoFi stock investors. Adjusted net revenue in the most recent quarter increased by 27% to 531 million. And while that rate of growth is slowing, the overall macroeconomic environment is slowing economic growth overall. And so SoFi being a bank and generating a significant amount of revenue from lending services, it's understandable that its revenue growth would slow down with higher interest rates decreasing demand for people to borrow money. So the financial services segment achieved a contribution profit of 3.3 million at a 30% margin. The technology platform achieved a contribution margin of 36% versus 20% in the second quarter and 23% in the year ago quarter. Now, the thing to remember with contribution margin is it highlights the profit margin of the incremental revenue. The incremental revenue. That means the revenue that's just now coming in, what's the profit margin of that revenue? It's not counting the profitability of that segment overall, just the incremental profit. The next $100, how much profit will that generate? Well, for SoFi in this segment, in these segments, those profit margins are highlighted here. The trouble is that if revenue were to, for some reason, decrease in these segments, that would work against it going the opposite direction. So it would create a decrease in profitability at a multiple of the decrease in revenue. Hopefully, SoFi stock investors don't see that happen anytime in the near term. So the next thing to highlight is that the company's net interest income is now nearly 2 times greater than their expenses. The segment contribution margin improved by nearly 300 basis points sequentially to 60%. Now, the interesting thing with banks and interest rates is as interest rates increase, it has the potential to increase profitability for banks because companies like SoFi will increase the percentage rate that they charge borrowers faster than they increase the percentage rate that they pay on checking and savings accounts. And so that creates a bigger and bigger and bigger gap between what they're paying their customers for deposits and what they're charging their customers for loans. And so that increasing gap is the net interest margin, and the higher interest rates go, the greater that gap becomes, and it increases profitability for SoFi's lending business. However, that's not without risk because the higher interest rates go, that means economic activity is likely slowing because if interest rates are higher, people are less likely to buy anything that comes with consumer financing. Things like buying a car where you need to get a loan, that depends on the interest rate. If the interest rate is higher, you're less likely to buy that car and therefore borrow that money. And then with homes as well, you're less likely to purchase a home if the interest rate is higher. You're less likely to take out a student loan if the interest rate is higher, and so on and so on and so on. And so that decrease in activity decreases economic prospects, decreasing jobs, possibly leading to a recession, which will then lead to defaults on existing loans. And SoFi has billions and billions of dollars of loans outstanding. And so if these higher interest rates lead to a recession and lead to job loss, which will likely lead to defaults on payments, then that will be bad news for SoFi in a greater magnitude than it is good news in the increase in net interest margin. So this is something that SoFi stock investors need to pay attention to closely, because as a bank, and as a bank that has an increasing proportion of its loan portfolio in personal loans, the riskiest kind of loans, right? That's where SoFi operates for its majority of its loan portfolio. It's in personal loans. I've done videos before where I've talked in depth about the increasing percentage of SoFi's loan portfolio being in personal loans. Those are the riskiest because those are the first things that consumers will default on when they're thinking about their overall loan portfolio, right? So let's say you're a consumer, right? And you've got a car loan, you've got a mortgage loan, and you've got a personal loan, and you lose your job, unfortunately. And for a while, you're able to maintain your payments through savings, but after a while, you need to make a choice on which one of your payments you're going to make. Is it going to be the car loan, the mortgage loan, or the personal loan? The first thing to go is the personal loan, because if you default on your personal loan, it's going to hurt your credit, but you're not going to get your car repossessed and you're not going to get your home foreclosed on. Those two will come after defaulting on your personal loan. So SoFi puts itself in the front position, in the front line. Think of it, if you're in a war, you're in the front line. Those are the first people, those are the ones that are in the greatest danger. SoFi is in the greatest danger if there is an economic downturn, because it has the biggest proportion of its loans are in personal loans. So this is something to keep an eye out for. SoFi Bank reported 84.8 million of GAAP net income at a 19.3% margin and 13% annualized return on tangible equity. These are good numbers. These are good numbers for SoFi's bank. But again, remember, with the bank, everything looks good and good and good until there's a recession and there's job loss and there's defaults, and then some banks end up losing more in that one recession than they made in the previous decade. And so that's really when you get to see how good of a business a bank is through recessions. How do they perform through recessions? And since SoFi only recently got its bank charter, we haven't really observed how SoFi will perform during a recession. And so that's a big uncertainty, a big question mark hanging over SoFi's head, is how will it perform during a recession? Now, it can go two ways. After a recession, if SoFi performs well, meaning the default in its portfolio is less than expected, then the stock price could explode, because investors can now say, okay, we've seen this company go through a recession and perform better than other banks. And so now that's one risk, that's one question mark that's gone. And so now we can more aggressively invest in SoFi stock. Or it could go in the opposite direction, where SoFi goes through the recession and things turn out worse than it expected, more defaults than expected, billions of dollars in losses in its loan portfolio. And then investors can say, okay, we see what's happening here. SoFi was sacrificing quality of its lending, taking on more risk than it should have, and now it's paying the price for it. And so we should be less willing to invest in SoFi stock. So it could go either direction here for SoFi in terms of how it performs in the next recession. And I couldn't tell you how it will perform. All I can tell you is that, all I can show you is the composition of its loan portfolio, being that it's concentrated in personal loans more than any other loan, and therefore it puts the company at a greater risk than most other financial lending institutions. In fact, let me show you that loan portfolio. Okay, here's the chart. Now I've showed this chart in several of other of my SoFi stock videos, but I wanted to show it again here because I was talking so much about SoFi's personal loans as a percentage of overall. You can see here the personal loans, student loans, home loans, and then total here on the bottom. Total unpaid principal, SoFi has $20.2 billion of debt outstanding, unpaid principal. Of that 20.2 billion, 14.177 billion is unpaid personal loans. So a significant portion of its loans are personal loans outstanding, right? 14.177 billion out of the 20.2 billion is personal loans. So that's why I was taking a greater degree of time in highlighting this risk with SoFi. So one thing SoFi has done extremely well is attract new customers, and SoFi continues to fuel high quality deposits that increased by a record of $2.9 billion sequentially, and the company ended the quarter with nearly $16 billion in deposits, and more than 90% of their deposits are from sticky direct deposit customers, and 98% are insured. Now, the thing to highlight here is that yes, these are high quality customers and these are good customers to have, but they come at a price because SoFi is offering these customers a checking account rate or a savings account rate over 4% to open that new checking account. So that's nearly $16 billion that SoFi needs to pay 4% interest on in order to have that money in its account versus many of the other leading banks. You could think of Bank of America, Chase, they're paying 0% to have customers deposit the money in their accounts, and customers are keeping a lot of money in those banks. So for SoFi to attract customers to itself, it needs to pay this high price to get these customers over. The good news is that it's working. At least it's working. Yes, they're paying a high price, but at least it's working and they're attracting customers. So they added 717,000 new members in the third quarter, bringing its total new members up to nearly 7 million. That's up 47% year over year. So it's working. It's costing them an arm and a leg, but it's working. So as of the end of the third quarter, over 65% of their loans were funded by deposits, and the new $2.9 billion of deposits in the new quarter were essential in funding their $5.2 billion in loans. So the thing to remember here is that even though they added $2.9 billion in deposits, the company lent out $5.2 billion. So to bridge that gap, they needed to borrow money or dip into savings. And so they're still making loans in excess of the deposits that they added, at least in the most recent quarter. Unfortunately, the tech platform saw revenue growth of only 6% in the quarter to 89.9 million. A lot of SoFi stock investors were expecting this tech platform to increase at a faster rate in order to fuel the company's growth in other areas outside of lending. Unfortunately, that wasn't the case in the most recent quarter, although management does expect this to grow to accelerate in the next few quarters. So we got some big news out of SoFi stock in this quarterly earnings call. The big items really coming from the fact that the third segment is now profitable. The company reiterated its forecast to be profitable on the bottom line next quarter, and that the company attracted billions of dollars of new deposits. What was a little bit hidden from this quarterly conference call and what I shared with you with the loan portfolio is that this growth is coming at the expense of greater risk. The company is becoming more and more risky as it continues to grow and grow and grow. And so that's an interesting aspect that SoFi stock investors need to continue to monitor, is the riskiness of the business and how much the company is giving up in terms of safety in order to continue growing. All right, but before I let you go, if you gained any value from this video, please subscribe to the channel. It really helps support growth. Thank you so much for watching.